Hi, this is a short video on how to calculate the loan payments for the Where to Live project. But the first thing I'm going to do is kind of explain loan payments and how each payment is made up of both interest and principal and how it changes over time. So what I'm going to look at is an example of a $300,000 loan for 10 years at 5%. So when you do that, in the first instance, I defined a period as 1 year. So you remember this is an important aspect associated with figuring out things like interest rate. When I define it as 1 year, then I can either write it as 300,000 times peak of an A 5% for 10 years, or I can use the Excel function, which is PMT 5% 10 years 300,000. Either way, it gets me a value of 38,851 per year. So I'll have to make 10 payments of that amount. Now in the other case, I could also identify the period as a month. So in this case, then I would take the interest rate and divide it by 12 and take the number of periods and multiply it by 12. So I could get a monthly payment of $31.82. So either way you define a period, you're just calculating the interest, the payments that you'll make on this $300,000 loan. Now what I'm going to do is I'm going to use the period definition and define the payments as yearly. So I'm going to use the value of 38,851. So when I look at that and I look at this payment over these 10-year periods, 38,851 every year, there's a portion of it that's going to be interest and a portion that's going to be principal. So interest is the amount of money that you are just paying the bank in order to use this money that they lent you. So it has nothing to do with the loan amount, it's just sort of like the rent on the money. And then the other portion, principal, is actually the function of paying down the loan. So you can see in the 10 periods, the blue line, the blue section, the blue portion is interest, and it goes down over time because you have less and less money that you are borrowing. And then the principal, because the interest rate goes down over time, the principal amount goes up over time. So let's go ahead and look at actually this calculation. So if I'm using an Excel spreadsheet here where I have a loan amount of 5% of 300,000. The first calculation I do is figure out, well, what is the interest rate for year one on this 300,000? So I take the 300,000 and multiply it by 5%, and that gives me $15,000. I know I'm paying 38,851. That's the payment I just calculated. So the difference between 38,851 and 15,000, or the interest amount, is going to be the principal amount. So that means the first year I pay off this loan, I'm actually only paying off 23,851 on the loan. So that means the balance at the beginning of the second year is 276,149. So that's because I've already paid off a little bit, the loan balance is less. So in order to figure out the interest rate, I calculate that 276,149 and I multiply it by 5% to get the interest portion. Now you see that interest went down from the 15,000 the previous year because the loan balance went down. Now I know I'm still paying 38,851, so then by difference, the principal amount is 25,044. So then I take the 276,149 and I subtract 25,044 from it, and I get a balance now. The balance is going down. The next time I'm going to go ahead and on that 251,105, multiply that by 5%, and that's the interest on that. And then the payment again is still the same. So by difference, the principal amount is that I paid in that third time period is that amount. So then if I go ahead and I do it for all 10 time periods, you can see the payments are constant every year. The interest portion of the payment goes down because the loan balance goes down, and then the principal goes up because the interest goes down. And so what we're interested in for tax purposes is we want to know what is the interest payment on this loan. And then for balance purposes, we want to know, well, what is the loan payment over time. If we want to pay it off at any point in time, what is it? So that's a little introduction on how to calculate this payment and then the interest and the principal. Now what I'm going to do now is I'm going to switch to the spreadsheet that has the case study in it for the townhome, and I'm going to show you how I did that calculation. So you remember when we looked at this before, this is for the apartment, and we went through all these columns and what they were and how to do the calculation in order to figure out what the net present worth is. Now the second option is a townhome. And what we need to do is we need to figure out the loan part of the townhome. So what I've done is over here I have information regarding the loan. So the townhome costs $370,000 and the down payment's 20%. So the loan you're taking out is $296 at 3.875. So now I'm going to go over here, and in this case I have the index year, the calendar year, the month, and then the total payment. This value here is that payment function where I take that interest rate of 3.875, divide it by 12 because I'm going to do this in months, take 360 because it's a 30-year loan times 12 time periods, times the N4 has the loan amount of $296,000 in it. So that gives me the monthly payment, and you can see that's constant all the way down. The next thing I'm going to calculate, just like I did in the other value, is I want to look at what is the interest in this first period. So I'm taking the loan amount that I have times the interest rate divided by 12 because it's monthly, and I get that value of $956. Now I know the monthly payment is $1392 and the interest is $956, so by difference it's just going to be $1392 minus the $956, and that's the principal amount. So then I take that principal and I'm actually going to add it up over time here to get the cumulative principal paid. That will then allow me to get the remaining balance. So this is after 1 year, this is the balance, 2 years, 3 years, 3 months, 1 month, 2 months, 3 months, 4 months. And this is the amount of principal I pay, which is just an accumulation of this column E. So you can see here I'm taking this previous value and I'm adding, wrong one. Take this previous value and I'm adding the principal amount, so I'm accumulating that over time. So then I can just lay this out, in each time period I'm going to calculate the interest that I owe in this time period, which is the balance, the remaining balance times the interest rate. And then by difference I just take the difference between the payment amount and this amount. So hopefully that'll show you how to do this spreadsheet, which is the monthly spreadsheet. And then what you have to do in order to get to the annual spreadsheet is you need to accumulate this for the whole time period. So in this case, I go to the townhome monthly mortgage and I go from D2 to times 12 because I'm going to get 12 a full year of payments on there. And then on the cumulative principal paid, I'm going to get the sum of the time period in this third year is going to be E26 to E37 is the townhome mortgage payments in that year. So hopefully that'll let you know how E26 to E37, so those 12-month periods. So that hopefully that'll show you how to do this particular part of the spreadsheet. And then the cash flow spreadsheet is very much like the apartment, it's just slightly different. So hopefully that'll help you a little bit for this video on how to do loan payments.